Hi, good afternoon and welcome to MF Corner. I'm Sumaira Abidi coming to you live from my home this afternoon. And today we have two very exciting topics and topics which hopefully are going to help our investors a lot. So first up, we're going to talk about the rookie mistakes that you can avoid when you're building your mutual fund portfolio. Basically, what not to do with Lovae Navlakhi, who's the Managing Director and CEO at International Money Matters. And a little later on the show, we're going to talk about something which we, very often don't talk about. What are the total expense ratios of mutual funds and how do they impact your returns? Joining in for this chat will be Mohit Gang, CEO and co-founder at MoneyFront. But now most people who have spoken about mutual funds have heard of a term called the TER or the total expense ratio. But have you really understood what it means? So joining in, I have Mohit Gang of MoneyFront, who's going to tell us exactly what this is. Mohit, hi, good afternoon. We know roughly that this is something which covers the running expenses of the funds, but what really comprises the TER or the total expense ratio?
Hi, Sumaira. Good afternoon. So look, I think expense ratio, as people popularly know it, it's also called TER or the total expense ratio. It's the percentage of operating expenses of a mutual fund scheme, which is charged within the daily NAV published. So every day, at the end of the day, whatever NAV you are seeing for the scheme which you hold in your portfolio, there is a certain percentage of expense which has gotten deducted from that NAV, and after that the NAV has got published. So that percentage of deduction is the operating expense of the scheme. And that's actually the expense ratio which is charged every day. And there are multiple components to it, Sumaira. So, okay. So
Mohit, go ahead. Sorry.
Yeah, so I was just saying in terms of components, so there are three broad components which this expense ratio covers. One is the OPEX, which is the operating expenses of the scheme, which could be the transactional costs, the admin charges, the trusteeship fee or the investor education fee, and so on and so forth, right? The second and the most important part is the sales and the marketing expense, which is the brokerage which gets paid out to the distributors across the country. And the third part is the management fees, which is the fund house's profitability or the expenses which they want to retain in terms of their charges. So these are the three broad components of the TER.
Okay, Mohit, how exactly is TER calculated? And very often we see that different schemes, but within the same category, have very varying expense ratios. So what is the reason for that?
Okay, so look, basically what SEBI has done under Section 52, they have prescribed certain rules for a maximum limit of total expense ratio which could be charged to a particular scheme. So if it's an equity scheme, and let's say for the first 500 crores of AUM, you can charge up to 2.25% as an expense ratio. Debt schemes will have 0.25% lesser for the same amount of AUM. And the grid goes that way. It's like an income tax slab. The higher the AUM, the less you can charge. It's a reverse slab actually. And at 50,000 crore of AUM, a particular scheme in equity category can only charge a maximum of 1.05%, and a debt scheme can charge 25 bips lesser with the same AUM, so they can charge a maximum of 80 bips in that scheme as an expense ratio. Now, the most critical part out here, Sumaira, is that the expense ratio ka total limit is capped, so you can't charge beyond that limit, but within that, the components can switch. They are fungible, right? So you can charge a higher amount of management fees if you want to improve your profitability. Let's say if the fund house wants to improve their profitability or their earnings, they can charge a higher amount of management fees and reduce the brokerage. Or vice versa is also true. If you want to incentivize the network, you can increase the brokerage part of it and reduce the management fee part of it. So it's fungible within the higher limit set. Also to mention, basically this is charged daily from the NAV of the scheme. So when you see that you have a scheme which has a regular plan and a direct plan, right? The expense ratios are charged to both the plans. In the regular side, you will have brokerages included in the expense ratio. So the expense ratio is a little higher. On the direct plan, the brokerages are not included in the expense ratio. So the expense ratios are a little lesser. And the lesser the expense ratio of a scheme, whether be the regular category or the direct category, the higher will be the returns of the scheme and the higher will be the NAV of the scheme.
No more, especially between this direct and regular, you get the basic theory, right, that direct will be cheaper and a regular plan will cost a little bit more. But even over here, there is a vast difference between schemes of the same category, right? Like even say a large cap scheme, some direct schemes will charge 1.2%, some will charge 0.5%. So what is the reason, and I mean, what exactly is this difference, ideal difference between direct and regular plans, and where should investors be worried if they see very, very high expenses for direct plans?
So look, I think expense ratio is a very critical factor when it comes to analyzing a scheme. Just as a broad contour, when you are analyzing an equity scheme, and let's come to the large cap category first. Let's take few examples, maybe an Axis Blue Chip Fund, right? That's a very popular scheme with roughly around 25,000 crores of AUM. Now, first criteria is when the AUM is that large, obviously the maximum limit which a fund house can charge is capped to a certain extent, so they can't go beyond that extent, right? Now, the scheme's expense ratio might be somewhere around 1.83% or something, if I recall correctly. And under direct plan, it would be around 0.5. So there is a huge difference of around 1.3% between the direct and the regular plan, which means the return differential between the two plans will be massive actually. And if you see the 3-year returns, let's say if you go, if someone had invested 1 lakh rupee at the start of 2018 in the direct plan vis-a-vis the regular plan, the difference would tend to amount roughly to around 5,500 rupees on an investment of 1 lakh rupee, right? That's an absolute difference of 5.5% over a period of 3.5 years. Right, which means over a period of 10 to 12 years, that difference could be a substantial number of around 20 to 25% on an absolute basis, which is massive. So people don't realize actually that it's an annual recurring charge and it eats into your returns every year. Now, why is it different between different schemes? Look, Sumaira, I think every fund house or every scheme can have a different incentive behind the operation, right? So let's say an ICICI Blue Chip, for that matter, has a very little difference between the regular and the direct plan. But the difference is fairly high when it comes to an Axis Blue Chip or a Mirai Blue Chip, right? So there could be possible reasons for it. And one of the key reasons is if a fund house wants to incentivize the distribution chain a little higher to kind of promote their products or market their products down the chain, then the brokerages could be higher and the difference between the direct and regular could be substantial. So that's perhaps the key reason why the difference is higher. From equity, if you move to debt, the expense ratios becomes extremely significant. Even if you're investing in regular plans, let's say, in debt, the first biggest thing which an investor should do is to see what is the YTM of a portfolio. That's the starting point to invest in debt. Of course, after checking the credit quality and the papers and all other things. And then you deduct the expense ratio and see what is the net YTM which is coming into your hands. Most often than not, what happens is, let's say you will see a liquid fund. You will see that the YTM of the liquid fund is roughly around 3.3% or 3.5% or whatever, thereabouts, right? But if the expense ratio is higher, let's say the expense ratio is around 35 bips, the in-hand yield to the client is fairly low. Now, in a liquid, there is very little differential which you can do within the paper quality or the portfolio matrices, right? So one liquid to other liquid, there is very minuscule difference. And the key component out there then becomes YTM and the net YTM post the expense ratios. So in a debt scheme, one has to actually go deep down, deduct the expense ratios from the YTM and see what the net YTM of the fund is. There are instances we know of where schemes of ultra short nature or low duration nature run an expense ratio upwards of 1% also, which considerably eats into the YTM of an investor. So you have to be very, very cognizant when you're investing into debt schemes that your net YTMs are fairly attractive after deduction of expense ratios.
Okay, Mohit, just to wrap up, is there any category of funds where paying expenses or higher expenses is warranted?
Look, I think very often, and you would find many people coming on your shows and prescribing that. If you're into small cap and mid cap categories, smaller AUM is advisable to a certain extent. Let's say a scheme size of around 2,000 to 4,000 crores is much more nimble. The portfolio can be a little more agile. Coming in and out of a stock can be easier because liquidity is a big concern in the portfolios. So out there, because the scheme size is lower, and as per the prescribed formulas, the expense ratios will be higher, right? But the active management part out there is fairly in the eye. And you know that you are seeking that alpha out there in those schemes. So there, I think a higher expense ratio is justified because the ability and expertise of fund management is also higher. And the prescribed formulas of SEBI also permit you to charge a slightly higher fee out there. So in those categories, yes, you have to give that leeway that the expense ratios will be a little higher. And vice versa, when you're running an index fund or a passive strategy, you can't pay a higher expense ratio. So if you have an index fund which is charging you 1% expense ratio, that's absolutely blasphemous. You can't have an index fund. You're just copying the index. So you have to be as low on the expense ratio as possible. The lowest expense ratio, the better.
Understood. Mohit, thanks very much for joining in. So quick takeaways. One is your NAV is calculated after accounting for expenses. Second is that in debt funds, expense ratios might be the defining, might define your choice because of the difference in returns. And finally, for equity funds, you're paying for active management. So make sure you're getting it. Mohit, thanks very much. With that, we'll wind up on MF Corner. Do stay tuned for closing bell.